Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
So let's just lay out the facts of what happened. On December 14th, Rocket Lab executes this flawless, completely successful mission for JAXA. I mean, operationally speaking, it was a perfect day. It cements the electron's reliability, and yet the very next morning, the market opens and RKLB shares just fall off a cliff. We're talking a sustained decline, closing down somewhere between, 7.8 and 10% to 55.44. And the volume was just massive, over 22 million shares. That price action, right there, that's the anomaly we need to dissect. It just completely defies the positive news.
Right, and that profound disconnect is the central tension here. I mean, you have undeniable operational success on one hand, and then this harsh market repricing on the other. So the question we have to figure out is whether that steep drop on December 15th represents, transient technical noise, maybe a psychological blip in a bullish story, or if it's a fundamentally justified correction, one driven by the sobering reality of the company's execution timeline and its, let's be honest, highly aggressive valuation.
My position is that this is technical and it's temporary. This was a textbook sell the news event. It was amplified by the simple fact that the stock was, technically exhausted. RKLB had rallied so aggressively all year, up over 140% leading into December. So that JAXA launch, it was already priced for perfection. Once that catalyst passed, the short-term profit takers they took their money and ran. And the technical picture took over from there.
See, I think focusing on profit takers misses the real gravity of the situation. The severity of that reaction, it's fundamentally justified by financial reality. We cannot talk about RKLB without confronting its extraordinary premium valuation. The company is trading at a price-to-sales multiple, a PS multiple of, over 40x? I mean, some estimates even push it past 50. For our listeners, that means a market is currently willing to pay $40 to $50 for every single dollar of annual revenue the company saw last year.
It's certainly a high multiple.
It's insane, frankly. When legacy aerospace firms trade at maybe 1 or 2 times sales, and when a company carries that kind of extreme valuation, it has virtually no margin for error. We know the critical Neutron maiden launch was formally delayed. It was pushed from the end of 2025 to Q1 2026. And that means analysts have already adjusted their models, pushing profitability targets from 2027 out to 2028. That extended timeline is the financial reality the market is reacting to. It makes that almost 8% drop a necessary compression of an inflated multiple.
Okay, I acknowledge the significance of the Neutron timeline, but you can't look at that delay in isolation. Right before this decline, the company successfully qualified the Neutron Hungry Hippo fairing. We have to pause on that for a second, because it's a colossal engineering feat. They proved that design could handle loads over 275,000 pounds of force. That is a huge engineering risk taken right off the table. It validates their progress despite the slip. And, on top of that, the massive $1.05 billion backlog is fully intact. The market just used a broader NASDAQ dip that day, what was it, 0.6%, as an excuse to realize profits on a stock that was just aggressively overbought, having surged from those November lows around $39.
I agree the fairing qualification is impressive, but engineering success doesn't pay the bills in the short term.
The financial reality is that pushing profitability out to 2028, it locks the company into a longer period of high R&D spend and increased cash burn. And this is a really crucial point. High PS multiples are usually for, software or biotech companies with minimal capital costs. RKLB is a hardware manufacturer. It is heavily capital intensive, and that extended timeline directly justifies the market's impatience. The December 15th drop, it just signals that the stock price is structurally incapable of absorbing even minor bad news, because the premium implies a perfection that hardware execution just inherently cannot guarantee. So let's drill down on the core driver here. Was this psychology reacting to technicals, or was it a sober financial assessment of that delay? I see why you emphasize the timeline, but I think the market's reaction back in November actually proves my point about psychological overreaction.
Wait, hold on. You're framing the November crash as psychological. But I would argue it proves the fundamental importance of the timeline. The stock crashed over 27% in November precisely because the delay was announced. That shows the market's primary focus is the neutron schedule and the cash consumption tied to Sir Peter Beck's strategy. And his strategy, mission success over speed, it's prudent, yes, but it is also highly capital intensive. The market is just rationally adjusting its expectations. The December 15th action was just a follow-up wave of selling.
That's an interesting point, though I would frame it differently. I think the core business health provides a financial cushion that makes the timeline delay less impactful than you suggest. Let's look at what the existing business is actually doing. Q3 2025 revenue was a record $155 million, a stunning 48% year-over-year increase, driven by their launch cadence and space systems. More critically, they achieved an impressive 37% GAAP gross margin.
37% GAAP margin is fantastic, absolutely.
Exactly. And for our listeners, GAAP margin, it just shows the company is highly efficient at generating revenue from its core business right now, Electron and Space Systems. That operational efficiency provides a massive financial buffer for Neutron R&D. The underlying growth metrics, they do support a premium valuation, even if it's stretched. The December 15th dip merely reset the relative strength index, a technical indicator, from being way overbought. It's just noise around a fundamentally robust company.
But can that electron cushion really sustain neutron R&D indefinitely while carrying a 40x PS multiple? If the path to profitability moves from 2028 to 2029, that 37% GAAP margin suddenly looks pretty insufficient to justify the current market cap. The market is pricing in perfect execution on Neutron, and the moment the stock went X news after the JAXA launch, the underlying fundamental pressure, that massive valuation, collapsed it.
Well, if we accept that this volatility was primarily technical, then we have to look at the market microstructure that amplified the move. We saw that extremely high trading volume, and throughout December, the stock maintained a substantial dark pool volume ratio, consistently hovering between 35 and 55%.
Right, and let's just clarify what that means for listeners. Dark pools are private exchanges where institutions can execute huge orders without tipping their hand. So high dark pool volume means a huge percentage of trading is happening away from the lit markets.
Exactly. But I would argue that for RKLB, that high off-exchange ratio is a structural feature, not a malicious one. It primarily reflects what's called wholesaler internalization. This is common for stocks like RKLB that have immense retail participation. When retail investors place those commission-free trades, market makers just internalize that flow. So, when half the activity is retail flow, the off-exchange ratio is naturally high. RKLB is a retail darling, and this structural reality shouldn't be confused with suppression or some kind of systemic weakness.
I disagree on the impact, even if I accept the mechanism. Wholesaler internalization obscures true price discovery in the lit markets, which institutions abhor. And furthermore, we have to address institutional skepticism evidenced by the short interest. We're looking at 9.61% of the float, about 45 million shares sold short. That's a huge block of institutional money betting against the current valuation.
I acknowledge the short interest, but we should also note that percentage has actually been declining since the November earnings drop. That signals bears recovering after the stock hit $39. That 9.6% is far from a dangerously crowded short trade. It represents healthy, calculated skepticism, not unanimous condemnation.
It's more than skepticism. Look at the specific spikes in fails to deliver, or FTDs. For the audience, FTDs happen when someone fails to deliver shares they sold, often indicating a liquidity struggle. We saw FTDs reach over 311,000 in mid-October. That confirms liquidity strain during these rapid rallies.
But those FTD spikes coincide precisely with moments when buying volumes surged. It just confirms that market makers struggled to locate physical shares when retail buying spiked. It doesn't confirm systematic weakness in the company's fundamentals. It's a market plumbing issue tied to retail enthusiasm.
But that retail enthusiasm is precisely what we need to question, because it underpins this spectacular valuation. The prevailing narrative on, platforms like Wall Street Bets is the do de insurance policy thesis, the idea that the U.S. government must ensure RKLB's success as a hedge against SpaceX. And while RKLB is genuinely on the NSSL Phase 3 Lane 1 contract list,
Which is a massive validation. It validates Neutron as a national security asset.
it validates eligibility, yes, but eligibility is not guaranteed revenue. Being on that list means RKLB is eligible to compete for up to $5.6 billion. The retail YOLO conviction, this idea that the stock has a high floor because the Pentagon won't let it fail, is aggressively priced. It requires flawless Neutron execution to convert that eligibility into funded contracts. Any further slip beyond Q1 2026 shatters that confidence.
I see why you question the retail conviction, but let me give you a different perspective. That bullish positioning, it's rooted in coherent, long-term competitive dynamics with SpaceX. They see RKLB's vertical integration as a unique, compelling counterweight, and this provides a high floor for the stock that short-term selling can't breach permanently, as we saw with the quick bounce back from that $39 low.
A $39 bounce back confirms volatility, not a high floor. It confirms that traders will buy the falling knife, but the fundamental risk remains.
I would counter that the coherence of their thesis is shown by their holding horizon. Many of these investors are holding for 5 to 10 years, viewing this as an infrastructure play. Plus, RKLB has a clean capital structure, no reverse splits, which distinguishes it from so many failed SPACs. That structural stability validates the long-term case, even if the price discovery is messy.
Messy price discovery is a gentle way to put it when a successful launch leads to a nearly 10% drop on enormous volume. That December 15th action is a flashing signal that the market views that valuation as extremely conditional.
And I maintain that the volatility is a function of short-term traders reacting to purely technical triggers, overbought status, market malaise, on a stock with undeniable long-term potential. I mean, it's supported by record revenue, a strong backlog, and deep vertical integration. The path to a $30 or $32 billion market cap may very well be justified if Neutron executes on that Q1 2026 timeline.
Well, the tension is inescapable. Rocket Lab operates like a successful, high-efficiency hardware company. You see that in the 37% gap margin. Yet its stock is priced like a scalable, zero CapEx software platform at 40 times sales. The severity of the December 15th sell-off, it just underscores that the Neutron delay fundamentally challenges that software-level valuation, making the stock violently sensitive to any technical pressure.
Right. The critical disconnect between that flawless JAXA launch and the severe sell-off on December 15th forces investors to confront extreme volatility. It's the ultimate reflection of a market trying to reconcile engineering reality with financial optimism.
Ultimately, the question of whether this is transient noise or a fundamental signal rests entirely on Rocket Lab's ability to execute on that delayed Q1 2026 Neutron launch, and then rapidly convert its NSL eligibility into funded contracts. Until then, investors simply must tolerate the substantial risk embedded in that high PS multiple.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.